Hi everybody, this is Ellman, the blue collar investor, and welcome to another one of my videos, this one entitled Using Covered Calls to Increase Dividend Yield. Today we're going to discuss a very conservative strategy that some investors may use instead of bonds, where you can generate very high returns relative to bonds, that is, in a very safe way. The strategy involves buying a high dividend yield stock and then selling a long-term, deep in the money call option to reduce your cost basis, thereby increasing the dividend yield and creating a significant amount of downside protection. The stocks that we would purchase for this strategy have certain requirements. First, it must be a stock that you'd be comfortable owning for the long term, usually about 1 year. Of course, the stock must have options associated with it, and in particular long-term options called LEAPs, which are options that have an expiration of greater than 9 months. And it must provide a dividend yield that meets your particular goals. Now, information on dividend and yields, there are many sites for that. One of them is the finance.yahoo site, which I show on the screen right now. And you'll see that I highlighted in yellow for you that this particular stock, and we're looking at GlaxoSmithKline, ticker symbol GSK. In the lower right part of the screen, I highlighted in yellow that this particular equity generates an annual dividend of $2.03, which represents a 5.3% annual return based on the current stock price, which you see on the upper left part of the screen is $38.07. Now, premium members that belong to the blue collar investor, you can get dividend yield information directly from the premium report on the running list, and I've highlighted that in green, in the green column for you. So if you want to look at a stock that has passed all the BCI screens, you can get percent dividend yield directly from the report. Once we've selected a stock, we look at the options chain, and we're looking once again for the long-term options called LEAPs. Now, this particular options chain, which you see on the screen right now, is the January 2012, as you could see on bold at the top of the screen. Now recall that the stock was selling for $38.07, and we want to look at a deep in the money call option. So I've highlighted in green for you the $25 strike, and if we scroll over to the bid column, we could see that that would sell at $12.90 per share, or $1,290 per contract. So that's the amount of cash that would come back to you if you sold the $25 strike. Now, the calculations before covered call writing would be as follows. We would take the $2.03 annual return per share divided by the per share cost of $38.07, and that would give you the 5.3% yield that you saw on the finance.yahoo site I just showed you. Now, if we reduce our cost basis by selling the covered call and we get back $12.90, our cost basis is now $25.17. Now, if we redo our calculations, we get a $2.03 return on a cost basis of $25.17, and that comes to an 8.07% annual return. It'll be slightly less if we sell the stock for $25. It would be 17 cents per share less. So it'd be slightly lower than the 8.07%. Now let's take a look at the increase in our returns. 8.07% minus the 5.3% represents a 2.77% increase. 2.77% divided by the original 5.3% represents a 52% increase. Once again, slightly less if we deduct the 17 cents. Let's take a look at the advantages of using this strategy. We get superior yields. In this case, the yield increased by 52%. We get downside protection. If we're assuming we're going to sell the stock for $25, well, that protection from 38.07 to 25 represents the protection we get by selling the deep in the money call. We get immediate cash flow. We get $1,290 per contract back immediately, plus we get our dividends. We know our maximum profit and we know our break even right from the get-go. And we can implement exit strategies if disaster strikes and the stock starts declining rapidly and we feel it might even go below the $25 strike. Now remember, deep in the money strikes have very high deltas. What that means is that the price of the option will decrease approximately dollar for dollar as the price of the stock declines. So if we need to institute an exit strategy, we could buy that option back cheaply because the deep in the money strikes have those very high deltas. And of course, since we have a 1-year time frame rather than a 1-month time frame, we have a lower time requirement to monitor our positions. Now the disadvantages. There's no upside potential. If that stock heads to the moon, we have an option obligation to sell at 25, so we don't participate in any share appreciation. As I said, because we're selling deep in the money calls, chances are at the end of that 1 year that the option will be assigned, our shares will be sold, unless we decide and it makes sense to undertake an exit strategy. And we must own these securities through earnings reports, which does represent some risk, but because we're selling such a deep in the money strike, that risk is greatly reduced. And the biggest disadvantage is we're getting a much lower yield than if we sold 1-month options. Once again, however, this is a safe strategy, it's a very conservative strategy, and it would be used in place of, let's say, the bond portion of our portfolio. So, in conclusion, we could sell deep in the money call options on high dividend yield stocks, enhance our dividend yield, and get quite a bit of downside protection. So I hope you've gotten some useful information from this video. You could reach me at Allen@thebluecollarinvestor.com, and you can always get a lot of what I hope you think is great information from my website, www.thebluecollarinvestor.com. I look forward to hearing from you. Thanks for taking the time to watch this video. Take care, everybody.